Good morning, this is Dave Toth with an RJO MRT Technical Webcast update on the gold, silver, and copper markets for Thursday, September 22nd. Starting off here with the 4-hourly chart of the December gold contract. You can see yesterday's and overnight's break below the most recent range of short to intermediate term support between 1765 and 1771 that now is expected to act as new resistance if this market is weaker and more vulnerable than we subjectively anticipate it is. And as a result of this latest spate of this month's weakness, we believe the market has defined Wednesday's 1819 spot 40 high as perhaps this market's single most important technical level, the recovery above which is required to not only stem this month's sell-off, but perhaps resurrect the secular bull trend to new all-time highs above 1924. In lieu of such strength above at least 1775 and preferably 1820, further and possibly accelerated losses should not surprise. Interestingly, from a longer-term perspective, looking at a daily log close-only chart basis here, the market's break today below the 1757 spot 30 low daily close from August 24th is sufficient to warrant long-term traders moving to a neutral sideline position. This market has been obviously in a secular bull trend, and we have maintained a bullish policy throughout. As a result of this failure, the market has provided enough weakness to warn or expose a major peak and reversal threat. We strongly believe or suspect that this month's sell-off is just the completing sea wave to a major bull market correction that will provide an outstanding risk-reward buying opportunity. And per a ultimately bullish count, it's interesting to note the market's encroachment on the area between the 1723 spot 70, 38.2% retrace of the July-August rally, and also the 1743 spot 40 level that makes this suspected C wave down from 1877 the same length as August's initial counter trend and suspected A wave sell-off from 1892 down to 1757. If this September sell-off is merely part of a broader bull market correction, then we absolutely need the market to confirm such with a bullish divergence in short-term momentum, and hence the importance of that 1819 spot 40 corrective high from Wednesday, the recovery above which will absolutely stem this sell-off and confirm such a momentum failure. In lieu of such a bullish divergence in momentum, we don't want to underestimate the very bearish prospect that the September sell-off is actually the third wave of a major peak and reversal threat that, along with what has been grossly significant bullish sentiment levels, could leave this market vulnerable to a significant sell-off. We find that a little difficult to believe subjectively given the extent to which the equity markets and the euro currency are now vulnerable. And the quality flight seems to now be shared between the US dollar index and perhaps the gold market if it can recover. But the long and short of it is at least the intermediate term trend, if not the new long-term trend, has been exposed as down in the gold market, with strength above 1819 spot 40 required to threaten that view enough to not only mitigate that bearish count but resurrect the secular bull trend. These issues considered, a bearish policy remains advised for shorter-term traders with tighter risk profiles, with strength above 1819 spot 40 required to warrant covering that and move back to a neutral to cautiously bullish policy. Longer-term traders are advised now to move to a neutral sideline position in order to circumvent the depths unknown of a larger degree correction or reversal lower. Similarly, moving to a daily log scale chart of the silver contract, you can see today's clear, decisive break below the 38.76 corrective low from August 25th. That, in absolute fact, breaks the multi-month rally from the May low at 32.30 and exposes at least a larger degree correction of this 32.30 to 44.27.5 recovery attempt, and quite possibly resurrects or resumes the broader bull market consolidation or correction process that's been in place since the April 28th high up at 49.56. As a result of today's clear and present decline, that exposes at least the intermediate, if not long-term trend is down. Strength above yesterday's 40.78 corrective high is now required to mitigate this sell-off, expose it, the sell-off from the August 23rd high at 44.27 as a three-wave and thus bull market corrective sequence, and re-expose the secular bull trend. In lieu of such 40.78 plus strength, further and possibly accelerated losses are expected straight away, with the lower recesses of this year's range down around 32.30 certainly a possible target. This downside risk is particularly important as following today's break, given the extraordinarily high level of bullish sentiment, according to our MRT Bullish Sentiment Index of hot managed money positions reportable to the CFTC. Indeed, at a recent 95% level or reading, this indicator is historically high, and with last week's reading of 94.7, reflecting 28,000 long positions to just 1,500 shorts. That creates a tremendous amount of fuel for downside vulnerability, and hence not wanting to underestimate the extent to which this market might not only continue lower but accelerate lower. Finally, and perhaps most indicative of the weakness being proven in the equity markets, the daily log scale chart of the copper market shows the extent to which this market is totally melting down. It's accelerating the broader developing downtrend from this year's earlier high up at 465, and as a result of the past week's reaffirmation of this broader downtrend, strength above at least the 388.5 prior low and support from September 14th is required on a major scale to jeopardize the impulsive integrity of a much broader bearish count. In lieu of such strength above 388.45 or above at least yesterday's 377.75 minor corrective high, further and possibly accelerated losses remain anticipated. The long-term weekly log scale chart presents perhaps the best picture of the extent to which this market has eroded and still remains vulnerable. You can see the market has sharply broken through the 50% retrace of the entire June 2010 to February 2011 rally from 272 up to 465, again on a logarithmic scale. That confirms the long-term trend is down. And you can see virtually no levels of any technical merit between spot and the June 2010 low way down at 272. That doesn't mean we're forecasting move all the way to 272, but it does mean that until or unless this market stems this clear and present downtrend with a confirmed bullish divergence in momentum above a recent corrective high like 377.75 or 388.50, any amount of downside remains in play, including a run at the 272 low from last June of 2010. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.